top markets lost $233 billion with your city next. The mainstream narrative that all real estate is safe. Homeowners in San Francisco, Dallas, and Miami are now watching their equity evaporate. Okay, data bomb here. While the U.S. housing market just hit a record $55 trillion, 10 of the biggest markets have quietly shed a combined $233 billion in value. Investors need to know who the winners and the losers really are and how to protect a portfolio. Okay, what are these cities? 10 major U.S. housing markets lost a combined $233 billion in value between June 2024 and June 2025. San Francisco saw its total home value plunge by $52 billion. Dallas dropped $37 billion. And Miami lost $25 billion. Despite the losses, though, these top 10 markets that gained value added $484 billion, pushing the total housing market up to $55 trillion. Oh, here's one. This one's interesting, actually. New York City housing markets gained more than $260 billion, and California still holds nearly 20% of national home values and roughly $10.8 trillion. New York's going to go to hell, though, if they elect this new mayor, and that will turn into a socialist cesspool. So New York will soon lose billions of dollars.
It's all interesting. I mean, I hear this, and I really want to know, like, on a personal level, how are your guys' investments, in San Francisco, Dallas, Miami? I know you guys own a bunch of stuff in New York and California as well.
Those are the only places we buy.
Yeah,
I'm curious. States for us. Yep.
How's your personal portfolios doing in those markets?
Well, before I answer that question, that was rooted in total falsities. There are several real estate markets in our country. And they all behave differently. People love to be like, oh, what's the U.S. real estate market doing? Which is such a dumb question because there's several markets, and depending on where you are, they're going to behave totally differently. And these, by the way, these cities that we're looking at that have lost the most, not that long ago, they were the hottest. They're like, oh, go invest in Miami, go invest in Austin. San Francisco's taking off like crazy. Like we talked about this before, there's cranes in the air. People are building everywhere. It's exciting. There's industry everywhere. But it's a lot of speculation. And now I think we're seeing the other side of that. And so now Gabe asked, well, how are investments doing in these cities? We're not in any of these cities. And I think the reason is we're always looking for a market that's steady as she goes. It's been steady for 20, 30 years. We can predict that it's going to be steady for another 20, 30 years in the future versus these boomer bust, exciting, crazy, speculative locations.
Well, I'd be curious to go back and look at how these cities did in the '08 crash, because I know a lot. I mean, Vegas, Reno, like places in Arizona, like Phoenix. I think I would, and I don't know this, so maybe if you're listening, comment on this. We could have Dumbass Dylan pull up the data. That's probably wrong. But I think a lot of these cities got their teeth kicked in '08. So it seems like there's certain cities just seem to be speculative. I don't know. What do you guys think?
Well, what's interesting too, we talk about these losses, but how much of these are paper losses? When you talk about these large metros like San Francisco, Dallas, like Dallas market has been booming for a long time. But when you talk Miami, you talk, parts of states like California, New York, it's also like, where is that equity? So like equity can evaporate on paper, but a lot of these, more like legacy type owners and investors, like a lot of the old money in some of these cities are tied up in real estate, but it's not necessarily investors. It's not people necessarily looking to turn that money. So sometimes it's paper losses. And you saw that a lot in 2008 as well. In 2008, I watched people walk away from properties that were locked into 30-year fixed mortgages just because Zillow told them their house was worth more. So there's an emotional aspect to it.
You're totally right, but it affects your psyche. If people feel poorer, they're going to not only potentially take action with their home, like walk away or sell at a loss and just call it a day, but they also spend less. So it creates this recessionary behavior. You're like, look, I don't have $100,000 in my home anymore. It's actually upside down. So maybe we're not going on a vacation, or maybe we're not going to go, renovate the home or do. So it like the psychology, even though it's a paper loss, I think it does affect consumer behavior, and it sort of causes.
I agree, Mitch, but how big of a loss? Like during Travis's data bomb, he mentioned the 10 major U.S. housing markets lost a combined $233 billion in value. But $233 billion, it sounds like a big number, but over the 10 major U.S. housing markets, is $233 billion really that much? It's probably not. When you break it down, to each individual property.
Well, not only that, but what the data omits is what is it? How much has it appreciated since 2012? Let's say. I mean, is it up $3 trillion? But now it's just a correction because it was over frothy and supply and demand is balancing out. Like if somebody got into that market in 2012 or 2008, are they still up? And if I guess my advice to these people that are holding assets, if you underwritten based on fundamentals and you have solid cash flow, you didn't over leverage yourself, you didn't overpay, you didn't buy on slim cap rate margins, you're not scared. You're like, this doesn't mean shit to me. Yeah, it's down, it's up. I don't know what that means. All I know is I'm holding my assets, they're cash flowing. And then on the next cycle, they'll come back up.
We're seeing history repeat itself. Look, I was just finding some data here. The worst performing housing markets in 2008 were concentrated in states that experienced the most rapid price appreciation prior to the crisis, including California, Nevada, Arizona, and Florida. So we're seeing history repeat itself. Where there's excitement and there's speculation in one direction, you're going to see the yo-yo swing the other way, the pendulum swing the other way, right? So I don't know. I feel like these markets that we're reading about, it's slightly predictable.
It's very predictable. A lot of these markets actually pull back to where they probably should be. Like we saw this even recently, right? With cheap money coming out of 2020, 21, and early 2022, money was cheap and people were buying and, they were paying more for less of a return. They were paying more because the money was cheaper. And so their returns looked good in the short term. But then prices started to pull back in those markets back. It's not a big drop. It's back to where it probably would have been if we didn't have all this hyperinflation. If we didn't have all this hyperinflation due to cheap money and stupid money being put in the market and extremely historically low interest rates, it just pulls back to where it should have been. There's kind of that hyper excitement and people go into a market not on the fundamentals of investing, but on hope appreciation. A lot of people flood these markets. You saw this a lot in Phoenix and Vegas back in 2003, 4, 5. They flooded these markets because prices were going up forever. So people were paying for a property, believing that they could sell these a couple years later, or in some cases a couple months later and make money. And that did work. But that's not investing. That's hope appreciating. That's speculating. And we saw a lot of people doing that back in 03, 4, 5. And then they got their ass kicked in 08 when prices pulled back to what they probably would have been. And we kind of saw that again in some of these larger markets, post kind of near the end of 2022 when interest rates doubled and all these people were speculating based on prices and rents going up forever.
Yeah. And it comes down to supply and demand. I mean, we invest in, a lot of multifamily, mobile home parks, residential stuff. But when there's a lot of froth in a market, there's going to be a lot of money that goes into that market. And to Mitch's point, we need to build more units. We need to add more apartments. We add more apartments, we make millions of dollars. And all of a sudden you have an influx of supply that doesn't keep up with demand doesn't keep up, right? And so I got that reversed. You have an oversupply and demand is down. And then people have to lower rents, which lowers values. And then eventually though, people stop building. And then all of those extra units get absorbed and now you stabilize on your values and now you're back up into the right. And the people that can just hold on to assets through those cycles, they're going to be fine if they underwritten based on the fundamentals.
I love following Codie Sanchez. She talks about buying boring businesses. And part of the reason she talks about that is she's going and she's buying businesses that are not fueled by speculation. So there's less buyers and it's more based on fundamentals. And I think there's an argument for buying into boring markets where it's, in the Midwest, it's a small tertiary market or something outside of a city that's not seeing all this aggressive speculators come in and driving up prices, and you can actually buy things on fundamentals. And so I almost feel like when I look at our portfolio, I think most of our portfolio is in these boring markets. It's in towns that you've never heard of, but they've been consistent for years and years and years. And because of that, we were able to buy on fundamentals and we're able to grow our portfolio or our cash flow and our wealth on those fundamentals versus being like, oh my gosh, did you hear about Austin? It's insane. We got to go there. We got to be a part of this. That I feel like is a dangerous play based on speculation versus buying in boarding markets.
Well, and I think, it poses a question for like our young investors, our newer investors, like how much does this matter? And I think about my early years of investing, like I didn't watch TV. I didn't watch the news. I stopped watching the news in 2008. So it's been a very long time. And I never really watched it prior to that when I was a teenager and in my early 20s. So it's like a lot of this data, I think for a young investor, like the noise really has to be turned off. Like it's easy to listen to all those people that are not actively investing. If you're watching the news every day, like there's enough fear out in the world and in the market that you'll probably never want to invest in real estate. So I think like more than anything, like my advice to a younger or newer investor, like turn the noise off, stick to the fundamentals, go build relationships, get around people that are actively investing in real estate. It's okay to invest in your local market. Look in markets that you already know and understand or have people that you know, like, and trust in those markets and start building your portfolio that way. You can get really caught up in like, oh shit, these 10 major metros have lost billions, hundreds of billions on paper. But that probably really doesn't impact these young, newer investors trying to get into real estate. You're going to find those deals by going to meetups, building relationships, and putting some deals together. A lot of this stuff is like, I think more applicable to, I don't know, maybe nobody, actually.
I think that this specific show, the benefit of this conversation is to stay away from areas that are really, really overly speculative and exciting. Stay away from the herd. Don't follow the herd into these markets where they're pushing up prices and they're pricing in potential future appreciation. So like, yeah, turn off the news, but also understand when you're going into a marketplace, what is the excitement around it? Because if there's a ton of excitement for future businesses and people are building everywhere and people are bidding up prices, that's probably a place that you should avoid because it's probably going to end up just like the data we just read, where values are decreasing, you've got an oversupply situation. So I think the takeaway here, at least in my mind, is go find boring markets that you can actually get good cash flow deals.
I think migration plays a big part of that. I mean, you saw a lot of people fleeing certain states and like rushing to Texas. And then I've actually met several people that got to Texas and they're like, yeah, I thought like the grass was greener. I actually don't like Houston. I don't like it. I want to go.
Is there grass in Texas?
No, I don't think so. And they want to go back to, socialist California.